Mortgage rates continue to be an incredibly hot topic. And with the job numbers that came out today, it does look like that it's positioning the Fed to do another rate hike down the road. Now, that doesn't necessarily mean that mortgage rates will go up, but if the trend holds, it does look like we could see some additional movement in mortgage rates. Now, I wanted to talk to you about some options to lower those rates, and those are called buy downs. There's two specific types that I want to talk about today. One is the permanent buy down, which means just that. You are paying extra money in closing costs to buy the interest rate down for the term of your loan. So if you have a 30-year mortgage and you choose to pay this extra money in closing costs, then you can buy down that rate for the entire 30-year term. Now, the second option is getting a lot more talk these days, and it's called a 2-1 buy down. And a 2-1 buy down works very different. Typically, a 2-1 buy down is funded by the seller. And I'm going to go into this in just a minute, but it's funded by the seller. And what it does is it takes your interest rate down by 2% for the first year of the mortgage note. So what that means is, let's say you got an interest rate of 6.5%. That interest rate for the very first year, you're making payments off of a note rate of 4.5%. And then for the second year, it goes to 5.5%. So let's say you have a $300,000 mortgage on a 30-year note. That could save you in that very first year upwards of $390 a month. And a lifetime of both of those years would be about $6,000 in savings that is entirely funded by the seller. Now, there's definite benefits to a 2-1 buy down because you know every adjustment that's going to be made. So you're going to know when you sign for that mortgage note and when we talk about these that you're going to have, here's what your payments are going to look like for year one. This is what your payments look like for year two. And then for year three, for the rest of the term of your note, here's what the payments look like. So if you wanted to use that money to, say, buy some furniture for your new house, or a lot of times just to replenish your savings account from the down payment that you just used. Now, also keep in mind that there are refinance opportunities in every mortgage life cycle. So what we're anticipating, while rates tend to be a little bit higher than what we saw over the last couple of years, the mortgage industry is really, the economy is righting itself at this point. We went through a 2-year crazy time of crazy low rates, couldn't sustain it, nor should we have been able to sustain it. So what's going to happen is once we get to the numbers where the Fed feels confident that they've got us into a better position where a recession's not going to hit, or potentially tipping us into that, what that's going to mean is after a little bit of time goes by, those rates are going to drop, giving you a refinance opportunity as well. So you can capitalize on those first 2 years of lower payments, and then also being able to know you can potentially refinance down the road. Now, for more information how it benefits you, or as my realtor friends, of what this could do to help your listings, because maybe instead of dropping that sales price down by $10,000 or $15,000, maybe let's try to market it offering a seller buy down. It's going to be a whole lot cheaper. Your seller's going to net the same, and our buyers are going to also get a great benefit. So give me a call. Be happy to help you out.